A bank is a financial institution licensed to receive deposits and make loans. Banks act as intermediaries between savers, those with surplus funds, and borrowers, those who need funds. They provide a safe place to store money and offer various financial services, playing a crucial role in facilitating economic activity. Historical origin of the banking system in the world. The earliest forms of banking can be traced back to ancient civilizations. Ancient Mesopotamia, around 2000 BC. Temples and wealthy individuals accepted grain and other goods as deposits and made loans. Records show evidence of interest being charged on these loans. Ancient Greece. Temples continue to act as secure places for deposits, and some private individuals also engaged in lending. Roman Empire. Bankers, known as argentarii, provided services like money changing, accepting deposits, and making loans. They even developed rudimentary forms of checks and transfers. Medieval period. With the rise of trade, merchant bankers emerged in Europe. They facilitated international trade by providing credit and handling payments across borders. The Medici family in Florence during the 15th century is a prominent example of early merchant banking. The rise of formal banking. The modern banking system began to take shape in the 17th and 18th centuries with the establishment of institutions like the Bank of England in 1694. These banks were chartered by governments and had the authority to issue banknotes. This marked a significant step towards a centralized and regulated banking system. In India, the banking system emerges. The emergence of a formal banking system in India was largely influenced by European traders and colonial rule. Early attempts. The first banks in India were established by European agency houses in the late 18th and early 19th centuries. These included the Bank of Hindustan, 1770, which eventually failed. Presidency banks. The British East India Company established 3 presidency banks: the Bank of Bengal, 1806, the Bank of Bombay, 1840, and the Bank of Madras, 1843. These banks played a crucial role in financing trade and commerce. Joint stock banks. The latter half of the 19th century saw the emergence of Indian-owned joint stock banks, driven by a growing nationalist sentiment and the need for financial institutions controlled by Indians. Examples include the Allahabad Bank, 1865, and the Punjab National Bank, 1894. The Swadeshi movement. This movement in the early 20th century further spurred the growth of Indian banks. The Reserve Bank of India, RBI. Established in 1935, the RBI became the Central Bank of India, responsible for regulating and supervising the banking system. Why did this concept be raised? The concept of banking arose primarily due to the inherent needs of developing economies and societies. Safe storage of wealth. Individuals and businesses needed secure places to store their surplus funds, protecting them from theft and loss. Facilitating trade and commerce. As economies grew, the need for efficient payment systems and access to credit for financing trade became crucial. Banks provided a mechanism for transferring funds and extending loans to merchants and businesses. Mobilizing savings. Banks provided a way to pool the savings of many individuals and make these funds available for productive investments, fostering economic growth. Managing risk. By diversifying their loan portfolios, banks could spread risk and provide a more stable source of financing compared to individual lenders. Issuing currency. The need for a standardized and widely accepted medium of exchange led to the development of banknotes issued by banks, initially private banks, later central banks. What's the crucial role of the banking system in the current world scenario? In the contemporary global landscape, the banking system plays an indispensable and multifaceted role. Financial intermediation. Banks remain the primary intermediaries, channeling savings into productive investments, driving capital formation and economic growth. Payment systems. They operate and maintain complex payment systems, facilitating transactions between individuals, businesses, and governments, both domestically and internationally. This includes digital payments, which are increasingly vital. Credit creation. Banks create credit by lending out a portion of their deposits, which fuels economic activity, supports business expansion, and enables consumer spending. Risk management. They assess and manage financial risks, providing hedging instruments and expertise to individuals and corporations. Facilitating international trade and finance. Banks provide services like foreign exchange transactions, trade finance, and cross-border payments, essential for global commerce. Implementing monetary policy. Central banks use the banking system as a key channel to implement monetary policy, influencing interest rates, credit availability, and overall economic stability. Supporting innovation and technological advancement. The banking sector is increasingly embracing and driving technological innovation in financial services, fintech, leading to new products, services, and delivery channels. Economic development. By providing access to finance for various sectors, including agriculture, industry, and services, banks contribute significantly to overall economic development and poverty reduction. What's bank nationalization? Bank nationalization refers to the transfer of ownership and control of privately owned banks to the government. This typically involves the government acquiring a majority stake in the banks, effectively making them public sector entities. The objectives behind nationalization often include aligning the banking sector with broader socio-economic goals and ensuring that credit is directed towards priority sectors of the economy. Why do bank nationalization in India? India underwent significant phases of bank nationalization primarily to address the following objectives: expanding banking to rural and underserved areas. Private banks were largely concentrated in urban centers and often neglected the credit needs of the rural sector and small borrowers. Nationalization aimed to extend the reach of banking to these areas and promote financial inclusion. Directing credit to priority sectors. The government wanted to channel credit towards crucial sectors like agriculture, small-scale industries, and exports, which were often underserved by private banks focused on large industrial houses. Reducing concentration of economic power. There was a concern that private banks were controlled by a few large industrial families, leading to a concentration of economic power. Nationalization aimed to democratize access to credit and reduce this concentration. Social justice and equitable growth. Nationalization was seen as a tool to promote social justice by ensuring that the benefits of economic development reached a wider section of the population. Strengthening monetary policy. With a large public sector banking system, the Reserve Bank of India could more effectively implement its monetary policies. Improving efficiency and service. It was argued that nationalized banks would be more focused on public service rather than profit maximization, leading to better service delivery. How are banks nationalized in India till now? Explain in detail. India has witnessed two major phases of bank nationalization. 1. The first phase, 1969. Context. In the late 1960s, despite some progress, the banking sector was still largely private and focused on urban areas and large industries. The government, under Prime Minister Indira Gandhi, felt the need for greater social control over the financial system to achieve its socio-economic objectives. The Ordinance. On July 19, 1969, the government issued the Banking Companies, Acquisition and Transfer of Undertakings, Ordinance 1969. Nationalization. This ordinance nationalized 14 major commercial banks that had deposits of 50 crore rupees or more. These banks included Allahabad Bank, Bank of Baroda, Bank of Maharashtra, Canara Bank, Central Bank of India, Dena Bank, Indian Bank, Indian Overseas Bank, Punjab National Bank, Syndicate Bank, Union Bank of India, United Bank of India, and United Commercial Bank, UCO Bank. Compensation. The ordinance provided for compensation to the shareholders of the nationalized banks. The amount of compensation was determined based on various factors, including the market value of the shares. Rationale. The primary rationale was to align the banking sector with national priorities, expand banking to rural areas, and provide credit to agriculture and small-scale industries. 2. The second phase, 1980. Context. Following the first phase, the government felt that some more banks needed to be brought under public control to further strengthen the banking system and extend its reach. The Ordinance. On April 15, 1980, the government issued the Banking Companies, Acquisition and Transfer of Undertakings, Ordinance 1980. Nationalization. This ordinance nationalized 6 more commercial banks that had deposits of 200 crore rupees or more. These banks were Andhra Bank, Corporation Bank, New Bank of India, Oriental Bank of Commerce, Punjab and Sindh Bank, and Vijaya Bank. Compensation. Similar to the first phase, compensation was provided to the shareholders of these banks. Rationale. The objectives remained largely the same: to further expand the geographical coverage of banks, improve services to customers, and ensure better credit management. Post-nationalization era. After these 2 major phases, the structure of the Indian banking system significantly changed, with public sector banks, PSBs, holding a dominant position. In the subsequent decades, PSBs played a crucial role in the economic development of the country, particularly in extending banking services to rural areas and supporting priority sectors. However, over time, PSBs also faced challenges such as inefficiency, mounting non-performing assets, NPAs, and a lack of competitiveness compared to private sector banks. In recent years, the government has embarked on a path of consolidation and privatization of some PSBs to improve their efficiency and competitiveness. This marks a shift in the approach towards the banking sector after decades of dominance by nationalized banks. In summary, bank nationalization in India was a significant policy decision undertaken in 2 major waves through ordinances and subsequent legislation. The aim was to align the banking sector with national development goals, expand its reach, and ensure credit flow to priority sectors. While nationalized banks played a crucial role for many years, the current trend involves reforms like consolidation and privatization to enhance efficiency and competitiveness.